Good day, fellow investors. As we said, we're going to look for value in emerging markets. One of the top stocks, the bigger companies in emerging markets, is TSMC, Taiwan Semiconductor Manufacturing Company. That is, of course, a big company, but it will give a good reference for all other stocks that I'm going to do on emerging markets, and also it is a great comparison to Intel. So let's discuss the stock price, the fundamentals, make a quick valuation, risk and reward, and then compare it to Intel, and then you see, okay, what kind of investor you are. That will be the main message of this video. And also, TMC is a great company, a great business, and that's something we have to look out for when it comes to investing. If we look at the stock price, historical stock price, it has been a compounder, a 100-bagger over the last 20 years, and especially exploded over the last year and a half as 5G and high-frequency computer chip demand has exploded after COVID. The reason for the explosion is fast revenue growth over the last year since 1994, minimum 20% return on equity across cycles. Now, in the positive cycle, it's 30%. Expected 5 to 10% growth for the next few years. Now, with the latest earnings, 10 to 15% expected growth for the few years. Balance sheet, fortress, internal organic growth, no stocks issued, and it's paying a dividend. This is what explains a big, great company. When it comes to the business overview, TSMC is making the chips for Apple, Qualcomm, and all the other hot stocks that are being talked about in the environment. Plus, they are investing 28 billion, hopefully, in 2021 to really dominate the sector. They produce 56% of the chips, and they went now to kill the competition by really creating huge production capacity so that others don't want to compete as eagerly so that they can keep their profits and margins high. To really dominate the environment, they have also bought land in Phoenix, Arizona to build a mega production capacity there. And if we look at what the CEO said in the conference call, they are going to spend a lot now, 50% of their revenues. Later in time, it should fall down to 30% range for investments, but they are spending ahead of the revenue growth that will follow. So they are really expecting a lot of revenue growth, and they think they will grow really significantly and that the investments will lead to 10 to 15% growth over the next 5 years, as it was the case from 2010 to 2015. Also, the trend they are banking on, the mega trend of 5G and high-performance computer-related applications, because those are expected to fuel strong demand for their advanced technologies in the next several years. Global smartphone units to grow 10% year over year. That's great for the industry and also for Intel then, if the market is so good. And this is their revenue growth expectation that was 5 to 10%, now it's 10 to 15%, and this is really exuberant, but this is what we'll have to use in our template. If we look at what they do, so smartphone chips, Apple, Qualcomm, high-performance computing, and then there is also a lot of potential growth from other applications, not only smartphone, as automotive grows, etc., etc. If we look at fundamentals, the gross margins are around 50% stable, now a little bit higher, as there are supply issues, so prices go up, but operating margins also relatively stable, a little bit lower in the downturn of the cycle. Keep in mind, this is a cyclical industry. If they invest too much in production and there is not so much demand growth, then that might backfire, and therefore I expect a lot of volatility here. But their dividends have quadrupled over the years, and this is very important. All these growth stocks that you see around have incredible share growth because they issue equity to grow. Taiwan Semiconductor hasn't issued much shares. What is this? 2 million shares here and then nothing, because they grow organically. Another indication of a great business. Here, operating cash flows growing, tripling, capital spending also tripling, and now at 50% almost of revenue, but should go down to the historical average of 2030. Nevertheless, free cash flows are strong. Just for reference, this is all in new Taiwan dollars, so you can divide it by 28 and get US billion dollars. So we have a company with strong balance sheet, high margins, a dominating market position, and investing a lot of money to keep the competition away for the next years, banking on stable margins. So if they grow 10 to 50%, that's also something that we can expect to see with the dividend growing, which is something we'll need to use for our valuation. If we look at the last dividend, 0.44 cents per ADR, if I multiply that, I get $1.79 per share, which is approximately a dividend yield of 1.5%. But the stock price is 124. Let's see what's baked into the price. I have put, as they are investing a lot now, I have put a growth rate for the dividend of 10% and then 20% from 2025 to 2030. I'm using always my own discount rate of 10%. You can download this template, the link will be in the description below, on my stock market research platform, for free of course, and you can play around with the discount rate. And I have put a terminal multiple of 45, which implies that in 2030 the dividend yield will be 2.22%. And then I get to somewhere close to the current stock price. So this is the normal case scenario that's baked into the price. Of course, if expecting a 10% return from such a growth stock, if you put a 5% return, then everything can be different. Of course, you can put a normal multiple that's what, 25, and that gives you again a price now, but then it leads to a 4% dividend in the future and a 5% discount rate. Exuberant situation, terminal multiple on the current dividend of 65, which is 1.5%, and that stays in 2030, same growth rates, and then of course the present value is much higher on a 5% discount rate. If I change the discount rate, we are also, let's say, 20%, 30% upside from where we are, depending on the return you wish. However, let's take the worst case scenario, the Intel scenario. Growth rate of dividend 5% next 5 years, 10% subsequent 5 years, discount rate 10%, and then what Intel has, a terminal multiple of 10 for dividends and buybacks, which is Intel's situation. And even with such great growth numbers, but a different terminal multiple in the cyclical sector, the stock can crash, what's this, 75, 80%. This shows the risk. This is actually Intel now. So two competitors priced completely different. And if I compare things to Intel, the market cap is 1/3 of Taiwan's semiconductor company. The dividend is higher, but the free cash flows are actually double. So I would say that the biggest risk for Taiwan semiconductor is an Intel scenario. Good numbers, good growth, everything okay, but where it doesn't reach the expectations because of the competition, and they are always competing there, trying to kill each other. So free cash flow yield much higher with Intel. We can say this is a growth stock, so you are banking on expectations, and this is a value stock. You are banking on free cash flows just remaining stable. Given the outlook TSMC has given us for the general market, expected to grow 10% over the next 5-10 years, I think we might see also good times for Intel, even if it just picks the breadcrumbs left by the better technological competitors. We'll see how it goes. I hope you enjoyed this introduction and discussion in what are the risks and rewards for these companies. If you did, click that like button, subscribe. Thank you for supporting the channel, and I'll see you in the next video.